Welcome, day traders. The new trading week began with a surprise from the People's Bank of China. After Friday's unexpectedly weak U.S. economic data, the Chinese regulator's decision became the second major factor influencing trading sentiment in the Asia-Pacific region. Contrary to expectations, the Chinese central bank did not cut the interest rate on one-year medium-term loans against the backdrop of ongoing deflationary pressures and a fragile economy. This decision does not seem logical. The figures on China's fourth-quarter GDP, December industrial production, retail sales, and unemployment will be released on Wednesday. These reports will provide more detail on the outlook for the world's second-largest economy, and today's decision by the Bank of China sent the offshore yuan to one-month low of 7.18 per US dollar. The US currency is also under pressure from the economic statistics after the release of weak reports on producer prices in the United States. Forecast for an early rate cut gained momentum. According to the FEDWATCH tool, at the beginning of Monday, 70% of the market believed that the US Federal Reserve would reduce the rate by a quarter of a point in March, while 3.3% expected the rate to be cut by half a point. At the same time, most central bank speakers are very cautious about possible changes in the US monetary policy. Thus, according to the Financial Times, head of Atlanta Fed RAPHAEL BOSTIC said that inflation could wobble if interest rates were cut too soon. The policymaker confirmed that price pressures fell faster than they expected in 2023. At the same time, BOSTIC believes that target 2% US prices will not be reached until 2025. The outlook for the central bank's auction looks very vague at the moment. Against this backdrop, it's difficult to the US dollar to decide on its direction. The unexpected decline in producer inflation compensated for the stronger consumer price data and influenced the decline on the Treasury yields. As a result, the US dollar ended last week unchanged. On a Monday, the currency was trading within a narrow range of 102.30 and 102.60. In anticipation of more relevant statistics, investors remain cautious at the start of the new week. In addition, the US stock market is closed today because of the Martin Luther King Jr. holiday, so the US dollar will show muted trading. However, given the overall bearish momentum, the greenback will continue to trade below the high of 103.10 and the next technical resistance. A break of the 102 mark would put the US dollar at a risk of breaking through the weak support level of 101.90 and testing the 100.60 level during a sell-off. In Japan, economic indicators, including decline in inflation and wages, have dampened bets on a near-term policy changes by the Bank of Japan, and today's machine tool orders data for December added to the disappointment. As the reports showed, machine tool orders in Japan declined by 9.9% year-over-year. While this is slightly better than the 13.6% drop in November, it's also better than the 9% predicted. The slowdown in economic activity is not conducive to the wage growth on which the Japanese authorities are pinning such high hopes. As a result, the yen, which ended Friday's trading session slightly higher at 144.5, come selling again in Monday. During the Asian trading session, bulls confidently steered the price of the dollar-yen pair within the daily range of 144.70 and 145.60. Tomorrow, markets will see the release of Japan's producer prices. However, we will also see the release of the Empire State Manufacturing Index. Thus, the yen may be dependent on the US economic data and comments from the US policymakers. Today, against the backdrop of a muted trading session in the United States, the dollar-yen pair may breach the 146 level and head towards the technical resistance level of 146.60. The next support levels are located at 145 and 144.70. At the same time, the Japanese currency is getting supported as a safe haven, and this factor is slowing its decline against the US dollar. However, the Australian and New Zealand currencies were the main losers today, influenced by the economic data and the Bank of China's auctions. The Aussie, which is often used as a liquid proxy for the Chinese yuan, plunged below 0.67 by the end of Monday's Asian session. Meanwhile, the Aussie dollar pair traded in the range of 0.6660 and 0.6710, extending the declines of the previous two sessions. The technical support level has shifted to 0.6526. The resistance area begins at 0.6880. On the one hand, buying demand for the Australian dollar is likely to continue to weaken amid heightened geopolitical tensions. At the same time, today's unemployment figures showed an increase of 0.1%, and this is the first increase since August 2023, showing signs of resilience in the labor market. In other words, the risk of a high inflation in Australia remains. The country's regulator will be forced to continue its aggressive policy. On these prospects, the country's currency may get some support. However, markets will get more details about the state of the Australian economy tomorrow, when inflation indicators and housing data will be released. The New Zealand dollar started the new trading week with losses. At the time of preparing this video, the Kiwi broke through a key level of 0.62, and the decline in the oil prices and the fall of the yuan sent the Kiwi down within the range of 0.6190 and 0.6250. The situation in the Middle East is diminishing risk sentiment and optimism in the equity markets. As a result, the Kiwi dollar pair may continue to decline toward the support area of 0.6000 and 0.6070. The next resistance is located near last Friday's high of 0.6270. That's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.